Hello and welcome to the Genuine Learning Blog. My name is Melissa Galasso, and today we're going to talk about a preliminary reviews document issued by the GASB on the financial reporting model improvements. So this is a follow-up to an invitation to comment that was issued regarding the governmental funds. This will address governmental funds plus a couple of additional items. Again, they plan to address many more things in the final GASB statement that will come out of this. So let's take a quick look. So this was issued at the end of September, actually the last workday of September, and it's Project 325. They gave us a pretty good amount of time for comments. Comments are due February 15, 2019. This is a pretty important topic, and as we know, we're getting close to the end of the year, so they wanted to give us an opportunity to really focus in on this and provide feedback, because if we read the actual preliminary reviews, they do discuss some of the feedback they received from the invitation to comment and how it helped them develop the answers that they're providing here. So I think it's important that we give this the attention that it deserves. So again, it's focused on targeting several concerns related to the governmental funds. We are familiar with the issue here related to governmental funds because they're some of the same ones they brought up in the invitation to comment. So looking at that concept of the short-term nature of them, right? Concern regarding inconsistency in timeframes, trying to understand how to put things together. There really was no conceptual framework for the current financial resource method. It was a hodgepodge of rules that they kept addressing, but then as more complicated transactions were coming along, they really didn't know what to do because there was no conceptual framework that underlined it. So basically everything was sort of done ad hoc, and they said, no, we really need to have a conceptual framework. So right now we use a current financial resource method, right? And we're recognizing the transaction when it's measurable and available. And that available has been very difficult, right? So it had to be during the reporting period or soon after, right? So we had rules about property taxes, for example. However, some governments, when they looked at their accounting policies, there were different policies when related to other sources. So you would be comparing someone using 60 or 90 to someone else who's using a 1 year. And so that comparability among governments is really an issue that they wanted to look at. So in the ITC, they offered three approaches. They offered a long-term, a short-term, and a near-term approach. And this is not any of the three. It's been modified based on the feedback that they received. And so it is going to create a short-term financial resource measurement focus, and it's going to report elements of financial statement from a short-term perspective consistent among governments, taking out the ability to have different time periods that we're looking at. And it's going to look at and reflect the amount of fund balance at period end that is available for spending next period. And so when we look at that, it may or may not be restricted. It may or may not have some contractual items on it. But we're just looking here to have more consistency between governmental entities in terms of recognition. So the recognition concepts here would be based on whether something comes from a short-term or long-term transaction, right? So if something came from a short-term, balances, outflows of resources, inflows of resources from short-term transactions and other events would be recognized when the underlying transaction occurs. So if the underlying transaction is going to be deemed to be a short-term transaction, then as the event occurs, we're going to recognize. However, if it's deemed to be a long-term transaction or other type of events that are long-term in nature, then the balance, outflow, and inflow would be when payments are due, right? So again, looking at it from that, we want to focus on the short term because that's what's important. We want it to be very similar to that budgetary concept, that short-term focus. And so they're separating it into the two. Now, what do you mean by a short-term transaction, right? These are things that are typically going to either convert to or generate cash or another financial asset, or require the use of cash or other financial asset within 1 year from the inception of the transaction or other event. So when we talk about short-term transaction versus long-term, this is the definition they provided for that short-term. What impact would that be? Well, if you look at the assets, cash, investments, AR, property tax receivable, prepaid, inventory, and notes and other long-term receivables that have become due, right? So they're long-term, but now they've become due and therefore will be shown. Things that would not be are going to be things like notes and long-term receivables that have not become due and capital assets, including intangible assets. On the other hand, if we look at the liabilities that would be recognized, AP, accrued payroll, accrued interest, tax and revenue anticipation notes, and unpaid balances due on general obligation and other long-term debt that became due during the period. So again, that long-term focus, but now has become due. So what's not going to be included? Well, unless it's due and unpaid, you're going to compensated absences, general obligation and long-term debt, pensions, OPEB, asset retirement obligations, leases. Those all would not be included on the balance sheet. And then in terms of the income statement, now I know we don't call them income statements or balance sheets, but just the overall concept here, the resource flows statement is going to have current and non-current activities, right? So when we think about this, we're going to separate them out so that we can see these are the ones that are coming from long-term versus short-term, because you're going to still expenditure as we go through this, a building. That is obviously a non-current activity that's going to be flowing. So we're going to separate them out. So what are some outflows? Salaries, use of goods and services, including inventory, long-term lending, interest, capital outlays, principal payments, right? So those long-term items would be separated into that long-term area. Things that would not be recognized, depreciation, right? No assets, no depreciation. Principal payments on the tax and the revenue anticipation notes, prepayments for goods or services to be received in the future, or purchases of inventory. Remember, those didn't flow as an expenditure. They went onto the income statement or onto the balance sheet. In terms of inflows, property taxes levied, sales income and other taxes related to the period, grants related to the period, repayment from lending activities that matured during the period, proceeds from long-term borrowings, proceeds from sale of capital assets. So things that would not be in there, repayment from lending activities due in subsequent periods, proceeds from tax anticipation notes, and revenue anticipation notes. So those would not be included. In addition, we would get some updated titles. The balance sheet would now be called Short-Term Financial Resource Balance Sheet, and the Resource Flow Statement would be a statement of short-term financial resource flows. All right, so let's move on now to what titles would we expect to see here. So obviously short-term assets, short-term liabilities, deferred outflows of short-term financial resources, deferred inflows of short-term. So you get the picture. So these are the elements that they would be having, and we've already covered the various types of assets and liabilities that would be included, right? So these are what our fund financial statements would look like for governmental funds. So in addition to having this short-term focus, we're also going to have a change in presentation. We're going to include an explanation at the very top of all the financial statements for governmental funds only that basically tell the user that they are for a short-term view only. So clarify to the user what the purpose is. And so this is the example that they have in there, and I've put it in quotation marks, as that is the wording that right now they're proposing to go on top. In addition to dealing with the governmental funds, which is what we've primarily covered, they did make a few other items that incorporate other items into the preliminary reviews document. And the first one's related to proprietary fund financial statements. And here they're focusing on operating versus non-operating and trying to improve comparability between governments. And so we would continue to have operating and non-operating. However, they're going to give it a clearer definition. So operating revenues would be defined as revenues other than non-operating. And so you're like, well, what's non-operating? So then they would go on to explain that non-operating revenues include subsidies received and provided, revenues and expenses related to financing, resources from disposal of capital assets and inventory, and then investment income and expenses. And when we think about subsidies, these are resources provided by another party or fund to help keep the rates lower than otherwise would be necessary to support the level of good and service to be provided. So they have also defined in here that subsidy concept. In terms of presentation, we would have a new subtotal. You would have to have operating income or loss, and non-capital subsidies would be presented before reporting other non-operating revenues. So again, kind of focusing in on presentation. So we would have, today we only have, if you think about subtotals, we would have revenues, expenses, and change in fund net position. As we go through that, the current requirements, you would add on this operating income subtotal. In terms of budgetary comparison, this is something I've always never really understood why we didn't require. We require the budget and we require the actual, but we didn't require a variance. So now going forward, you would be required to show the budget variance between final and actual and original and final budget amounts. So not only would you show the amounts, but the variance between them would now be required. So today we show the numbers, but we don't show the subtraction. This would basically give that subtraction. In addition, it would require the communication to be done in one way. It would be required to be RSI, or required supplementary information, in terms of the presentation. In addition, one other area that they wanted to do was really limit the alternatives for presenting major component unit information, and of course enhancing consistency. And so here, if you cannot present your major funds in a separate column, then the financial statements of the major component units would be presented in the basic financial statements, in the combining financial statements after the fund financial statements. So they did clarify and create consistency here. In addition, remember, this only applies here if you're presenting a CAFR, so you have to be a government who's preparing a CAFR, and this would be supplemental information. It's basically a new schedule here. It's a schedule of natural classification of government-wide expenses by function or program for governmental activities, and by different identifiable activity for business type activities. So again, when we think about this, this is very similar to the functional expense classification requirements on the nonprofit side, where you have to show function and nature. This would be a new schedule to help, again, provide that assessment of the financial flexibility of the government. And again, in that only if you're presenting a CAFR, and not every government does. Finally, they couldn't get to everything in this PV. Remember, the ITC only addressed governmental funds. The PV added on items like budgetary comparison and other funds and major component units, etc. Going forward, they do have plans to even work a little bit more in this area. So they're going to look at MD&A, trying to remove boilerplate language that we don't really need, but look at how can we improve areas regarding analysis, clarifying guidance on things about known facts, decisions, or conditions. And so really beefing up that MD&A area. They're also looking at debt service and considering alternatives for providing information about debt service funds. And then extraordinary and special items, again, focusing in on what could be, in terms of consistency, some additional guidance for reporting these type of items. So that is to come in the future. This is a very, very long-term project. It's coming out in pieces, and we're getting feedback throughout. So again, if you have an interest in this area, I would encourage you to respond to the preliminary reviews document so GASB knows what you're thinking regarding some of this proposal. So none of this is done. As we saw from the ITC, they gave us 3 approaches, and then they went with one that was totally different. I wouldn't say totally different, but incorporated the 3 that they had originally proposed, but then took into consideration the feedback that they received. And I would expect GASB to do that again here, where we would be able to provide feedback to make sure that our governmental funds, as well as all the other changes, make sense from a reporting model perspective. So thank you for joining me on the Genuine Learning blog, and I hope to see you on a future blog. Have a great day, guys. Bye-bye.